Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. Hello. So we come to the end of the year and it's time to complete my defensive stocks roundup. So earlier in the year, I took a look at the defensive sectors, which you can see down here, and I then used a stock screener to select ones which also had good revenue, good net income growth, and good net assets. So the stock screener I used is available on the London South East website, and here you can enter the index you're interested in and the particular sector and also all kinds of other attributes, and then it runs out a list of all stocks in the FTSE which meet your criteria. So once I had this list for each stock sector, I then would go through each share on Reuters, and using the Reuters.com website, here you have the financial statements, and it's quite easy to go through and then eyeball which ones are at least meeting this aspect. So for example, for AstraZeneca, we see that the revenue was about flat, and then the net income was actually dropping. So it dropped from about 3 billion to about 1.3 billion over the course of the 5 years. So that would kind of eliminate them already. And then particularly when I then looked at their debt, as you can see, is around 3 billion. So as you can see, it's possible to quickly run through each stock using the Reuters website and then whittle down the numbers so you know you've only got ones that are good, at least from the financial perspective. So that left me with these stocks, and I felt that it was still a few too many. So I then went back to Reuters and I deleted any ones that were there that had significant debt versus their assets and net income. So this left me with Kinetic, BAE Systems and Avon Rubber in the defence sector, Georgia Healthcare, Bar in the beverages sector, Kranzwick in the food products sector, Hikma Pharmaceuticals in medicines, Kainos Group Holding and Softcat in IT services, and Telecom Plus. Now, when I got to Georgia Healthcare, I discovered, and perhaps you could say the name would give it away, that it was based exclusively in Georgia. So I eliminated that one because it would take me a long time to try and understand the market in Georgia. Then Bar, by the time I got to analyse them, they'd come out with a trading report that because of COVID, their sales had completely plummeted. And as you can see, their net income here reduced from 19 million in the first quarter to 1.9 million in the second quarter. So clearly they were completely wiped out by the COVID. So that's why it's quite easy for me to then eliminate them. And finally, Telecom Plus. Well, unfortunately, by the time I'd analysed all of these other stocks, I'd run out of time this year to do Telecom Plus. So a bit lame, but there you go. So these were then the stocks that were remaining for me to look at in depth. And I've done videos for all of these. Now, first of all, Kinetic and BAE Systems, they were in my watch list after I looked at them. But a key risk I had for them was Joe Biden winning the election, and he's won. So I've decided to eliminate them. Also, they had a lot of debt and they were fairly opaque, so they were marginally not as solid as the other picks as well. So I was quite happy to delete them as soon as I found out that Joe Biden had won the election. Avon Rubber, I did an update on them quite recently, so they were certainly considered still in contention. Softcat I looked at in May, and they really were excellent across the board, and I purchased them as I was looking to buy a stock back then. Kainos Group Holdings are similar to Softcat, but the problem I had with them is they rely too much on the UK government, just a single customer, for a lot of their profits. So I decided to eliminate them, and I've got Softcat in the IT sector. Kranzwick, I also very recently did a video on them, and I eliminated them because even though they are an excellent stock, it seemed too much of a gamble with the Brexit situation. Now actually that was still the case when I made my final selection of one more defensive stock, but they still could have some problems, even though we now know we've got a good Brexit deal. It is expected that the cost of labour should go up. However, they are a strong stock, and although they're eliminated, they're certainly favourites in my watch list coming into the new year. So that leaves us with Avon Rubber, Hikma and Gamesys. Avon Rubber was an excellent play on the future combat soldier concept. This deal they had with 3M Ceradyne brought in a 0.7 million order pipeline for just the cost of 100 million, and they now are fairly cash rich. The cons with them is that their current business actually has an inferior net income due to the murky general and admin costs, which I find hard to understand. Now, we know that their share price is up 2.5, and it has actually been dropping quite a bit recently, but their assets and net assets have doubled, and their operating profit is only 2/3 and their net income only half what they were doing before all of this takeover activity. On the other hand, their future net income could well be a 4x plus, so it makes them quite a tantalizing business. In conclusion, I decided that their future share price relies on constrained general and admin costs, coupled with expected fantastic revenue growth. I find it very hard to understand the dynamic. When I was looking into their numbers, it was difficult for me to really tease out and understand the differences there between the rate of their increasing costs against the predicted rate of their increasing sales. So I've decided to drop them for some of the more lower hanging fruit. So having said that, should their share price continue to drop, I certainly think they're well worthy of re-evaluation at, say, around 2,000 to 2,500. And they're definitely going to stay in my watch list because they really do have a very interesting long-term potential. So Hikma Pharmaceuticals, and there's a really good bull case for generics. The worldwide population is increasing, people are getting older on average, and people are richer on average. So this really does make out for a bright future in generics. Also, I was quite astounded to see that the US actually spends 20% of its GDP on healthcare. And with Joe Biden getting in, plus MMT in full action, I am very convinced about the bull case for generics. They also recently had a approval for their Advair Discus generic product. This was a real achievement because lots of other pharmaceutical companies have failed to do that, and it validates their strategy and ability to move into inhalation and to move more into complex generics, because this is what will provide them their moat to protect them from competition from other generics companies. And we already know that they're doing well with their injectables portfolio. Looking at their financial statements over the last 5 years, it really was a beautiful set of numbers. There's not been very many other companies I've looked at that had such an amazing set of books as these, apart from one anomaly surrounding their takeover of the Columbia business. That really does make them very attractive to someone like me who likes to look at the financial statements. So the cons were actually harder to find for these than usually is the case. It is worth mentioning that 34% of the company's stock is owned by just one family, and they do have 0.7 billion of debt, although that is fairly normal for pharma companies. As we saw, AstraZeneca have a lot more than that. And they do also have 0.4 billion in cash. So Hikma Pharmaceuticals has a long record of stellar management and really good financial performance. And they also have a good growth strategy, particularly around the injectables and the complex generics. And only just recently, Joe Biden got elected, plus they got their Advair product approved. I couldn't really see any serious flaws with them. So for me, they're a definite buy, but let's just have a look at Gamesys. So Gamesys were very good as a way in to this global smartphone phenomenon. It really is curious when you walk around and you can go in the trains and in the high street, and see people glued to their phones all day. And this is one company I've found that is an excellent play on this smartphone addiction problem. Their gaming revenue was up 101% and 27% pro forma, and their net income looks set to quadruple in 2020. On the other hand, I was disappointed to see in their interims that their costs have broadly doubled along with the sales. We've got to remember that they're saddled with 0.5 billion in debt. And when I was trying to eke out their costs and the composition of their costs to try and then work out what will their net income be in the future, it was very difficult to understand from the information provided in their financial statements. If their net income does quadruple to 40 million, then it will be about the same as the 36 million they were making well before all this takeover action. So in conclusion, they're an attractive business with a good revenue trajectory. But in the end, I just couldn't fully enough reconcile the debt and future cost profile to match up against this expected revenue. And so I felt it was just a bit too difficult to solidly understand this for me to go in. I think, though, it will be good to keep them on my watch list, and when the full year report comes out, I'd love to go in them if there's enough information there for me to feel confident. So to complete my defensive stocks roundup, I'm pleased with my purchase of Hikma and also Softcat, and this has certainly been an excellent exercise to show that if you put the work in, I find myself in a situation where I'm buying stocks and I've got full confidence in how they're going to work. So there's a finalization of my defensive stock series. From putting the work in, I've given myself every chance to get a good results from these two stocks that I've purchased.